Welcome to the Mortgage Rate Weekly Market Update for the week of May 5th, 2019. Hello, I'm John Thomas with Prime Residential Mortgage, here to give you your update. Well, last week was a bit of a roller coaster ride for mortgage bonds. Take a look at the bond chart on the screen. You can see the previous Friday, mortgage bonds broke above a tough ceiling of resistance. The 25-day moving average with that green candle closed above it. That was a good sign. But on Monday, reverse course, you can see the red candle. We opened above it, but then sold off and closed below the 25-day moving average. Tuesday, we gapped down, but then with that green candle, we rallied higher to close just above the 25-day moving average. Wednesday, after the Fed first started speaking, we had a huge rally, rallied off the 25-day moving average. But as you can see, we closed down right back at the 25-day moving average at the end of the day. Thursday, mortgage bonds gapped down below the 25-day moving average. And then Friday, they gapped even lower, but then after the jobs report was digested by the market, mortgage bonds were able to rally higher. Basically, they found that there was low inflation in the jobs report, so mortgage bonds rallied on that, closed above the 25-day moving average with that green candle there. So with bonds above the 25-day moving average, again, that's a good technical signal. We're going to recommend floating your mortgage rate to start the week, but if mortgage bonds break below that 25-day moving average again, we'd quickly switch to a locking stance. But you can start this week floating your mortgage rate to see if mortgage bonds can build on this momentum and rally higher. Now, if we dig into the economic news, big report last week was the jobs report for April 2019, released by the Bureau of Labor Statistics on Friday. It showed 263,000 jobs created, very strong, well above the 180,000 jobs expected. And this was the 103rd month of job creation. So that's amazing. A big long run there for job creation. Now, we also saw the unemployment rate drop from 3.8 to 3.6% in the report. That's the lowest since 1969. That's an amazingly low report. But the unemployment rate fell because 490,000 people dropped out of the labor force, not because of the huge job creation, but it was a combination. We created jobs, but we lost 490,000 people out of the labor force. So that's not the reason we want the unemployment rate to drop. So we'll have to see how this plays out. And then we saw the labor force participation rate, LFPR, drop from 63 to 62.8%, and that would be because we saw 490,000 people drop out of the labor force, so we would see the labor force participation rate drop slightly. So that the pool of available labor fell to the least amount since 2001. So that means the people the people that want to work are working. There's jobs out there. Unemployment is super low. Employers are having a tough time filling good job positions. So overall, the economy is still doing very, very well on the labor sector. Then we saw in the report the weekly earnings declined from 3.2 to 2.9%. That was bond-friendly news because that basically shows there was not wage pressure inflation. It actually decreased on the weekly earnings. So bonds rallied on that news. That's what allowed us to break above that 25-day moving average. So all in all, very strong jobs report. But what we do have to be mindful of is when the unemployment rate hits the low, and if it bottoms out and starts to increase again, that has been a indicator of recession in the past. Now, the Federal Reserve met on Wednesday, and they decided to leave the Fed funds rate unchanged. They did not raise rates. The market did not expect it to raise rates this year at all. There's actually a 53% chance the Fed could cut the rate later this year. So we'll have to see if they actually do that. The Fed also announced they would begin reinvesting more of their proceeds that would normally fall off their balance sheet in the U.S. Treasury. So the Feds own mortgage bonds and treasuries. As interest payments come in and as those pay off, they've been letting that money run off the balance sheet. They're now going to reinvest more of that back into buying treasuries. That would be bond-friendly news. So as that starts to happen, we could see mortgage bonds benefit from that as well. Then we saw weekly initial jobless claims come out on Thursday. They showed 230,000 claims, which remained the same as the previous week. But if you look there on the screen, that's a huge trend breaker because weekly jobless claims had been trending down. Last week we had a spike higher to 230. And we thought that might be an anomaly because of the holidays, but with it coming in 230 again this week, that's obviously not an anomaly. And that was 15,000 worse than expectations of 215,000 claims. So if the unemployment rate, remember, bottoms out and starts to move higher, that's a very reliable recession indicator, so we'll keep an eye on that. Now, if we go to housing news, we saw pending home sales from March 2019 were up 3.8% to 105.8 on the index, which was stronger than an expected gain of 0.7%. Now, pending home sales are down 1.2% year over year, and we're looking for pending home sales to get stronger in April and May as the foot traffic has started to increase. As the mortgage rates drop, foot traffic is starting to increase. So we're looking for April and May's pending home sales to increase. That would be a good sign for the housing market. Then we also saw the S&P Case-Shiller Home Price Index for February 2019 was released last week. There's two indexes which people pay the most attention to, the 20-city index and the national index. The 20-city home index edged lower to 3% year over year from February of 2018 to February of 2019. The National Home Price Index increased 4% annually, which was a drop from 4.2% seen in January. So the monthly increase from January to February is still 0.2%. So don't get this wrong. Home prices still went up. It's just the rate at which they're going up is starting to slow, but we're in a great range. Anything between 2 and 5% is a very sustainable, very well range. So that is good news for us because we're hoping that it can stay in that range because that means home price appreciation can continue for a long time. Now, also in the housing news, there's a new down payment assistance grant program, the PMI DPA Advantage Grant. You can get 2% grant for home buyers. It's a 2% forgivable grant. It's 2% of the purchase price. There's no income restrictions for first-time homebuyers. A minimum 580 FICO score. You must use an FHA mortgage for your first mortgage, and you can negotiate up to 6% towards the seller-paid closing costs. There's more information on the blog on DelawareMortgageLoans.net. But if you're interested in that program, give us a call, 302-703-0727. Now, in the local news, we've got the next free first-time homebuyer seminar on Saturday, May 11th. That's this Saturday in Newark, Delaware, from 10 a.m. to noon at the Christiana Hilton Hotel. Then we're back in Wilmington, Delaware on Wednesday, May 22nd from 6 p.m. to 8 p.m. at the Independence Mall eXp Realty office on Concord Pike. You can register for either one of those events by giving us a call at 302-703-0727 or online, www.DelawareHomebuyerSeminar.com. And then we're back in Maryland on Saturday, June 22nd in Largo, Maryland at the library. From 10 a.m. to noon. You can register for that event, but give us a call at 410-412-3319 or online, www.MarylandHomebuyerSeminars.com. Look forward to seeing you guys next week.